Hi, I'm Manish Dhawan with my good friend Puneet Khurana. We run a blog by the name of stoicinvesting.com. This is our podcast series on decision makers. Idea is simple. Life is too short to learn from just your own experiences. To inculcate vicarious learning, we will be interviewing and profiling interesting people from different walks of life. Hopefully, this endeavor will shorten the learning curve for our audience.
Well, there are few business decisions that are counterintuitive and hard-hitting for an observer. When I first got to know that in the peak of a bull market, there was a mutual fund that was not celebrating the irrational exuberance of the public, but denying participation in it, sticking to the core values and ethos of a long-term investing. Well, I was really impressed. I was immediately caught onto it, and I realized that I'm looking at a very Maverick organization. I, Puneet Khurana, and Manish Dhawan, on behalf of Stoic Investing, welcomes to our new series of podcast on decision-making masters. And we have with us a Maverick decision maker, Mr. Kalpan Parekh, Managing Director, Sales and Marketing of IDFC Mutual Fund. Welcome, Mr. Parekh.
Hi.
Hi. Pleasure to have you here. For the benefits of the listener, can you briefly explain how you started in the mutual fund industry and how has been your journey so far? And what were the circumstances that led you to take IDFC to a different path than the normal AMC?
I started my career in 98 as a part of L&T's treasury function in their subsidiary called L&T Finance. And the brief 2-year experience there taught me a lot about fixed income markets because I was managing portfolios on the fixed income side. And it was also a period of emergence of private sector mutual funds. India had started deregulating interest rates from its peak of 14-15% to market-led rates. So that was a period when interest rates started falling and bond funds became very popular because when rates fall, bond funds tend to give equity plus returns also. So it was a period of 2-3 years where debt funds generated between 15 to 20% return, and it created an illusion that we are good money managers. I was a treasury manager because rates were falling and returns were coming up. And while I was doing that, I was exposed to one of the underlying mutual fund where we were investing our portfolios in those days, which was Prudential ICICI. So we met, and then I moved on the other side in the fund business. So it's been almost 16 years that I've been in mutual funds.
16 years.
I've spent around 9 years in Prudential, ICICI, then around 3 years in Birla Sun Life, and the last 5 years in IDFC. So,
but earlier you were in the research side.
So before joining the fund industry, I was mainly working as a dealer in the money market team of L&T Finance.
Interesting.
And the role was to basically earn spreads, borrow money at lower rate, and deploy money at higher rates, either in the bond market or through debt or equity mutual funds. So that was the first exposure to capital markets and mutual funds. And then I joined ICICI in a very eventful phase when it was 99 and just the beginning of the 99-2000 tech bull run. So my first stint by accident was I was deputed to Chennai to launch the fund house had launched a technology fund that time. It was world over tech, and the idea was to go and make investors invest in tech funds. So my early years of experience was basically raising money in a very expensive segment without knowing the pitfalls of investing at wrong valuations. And very soon in the next couple of months we saw the tech bubble collapse. These were defining moments because that's when you learned that it doesn't feel great when your investors lose money, especially when they invest on your word, and credibility is also at stake. So I think that was a very expensive learning of what not to sell and how to really guide investors towards disciplined investing. So that was the beginning.
At that time, you were in which fund, you said?
Prudential
ICICI,
yes.
Okay. So that was...
So I spent around 8 years. And then gradually, I worked... so I basically was hired to be the link between the investment team and the sales team.
Okay.
The whole idea was investing is complex.
Okay.
The fund industry then, and even to a large extent now, believes in talking a language of jargons.
Okay.
Whereas investors don't understand jargon. So the idea was to link between the two by, without diluting the basic concepts, transmit in a simpler manner. Mm-hmm. So started off in a role like that, which was a link between investments and consumers. And then over time, I built a career in sales and distribution over the last 15 years. Your second question was about
so what led to you,
IDFC doing what it is doing. So, I don't take credit for that. I think it is the ecosystem of IDFC as a group.
Okay.
So when I met IDFC in my interviews, what really appealed to me was the concept called nation building when you walked into the office.
Okay.
And it was very sensible for an infrastructure company to say that, because they were actually doing path-breaking work for nation building in various parts of infrastructure. But the question in my mind was, how can the same be applied to financial services? Yeah. Mm-hmm. So when I met my bosses in IDFC Mutual Fund, the first thought that I learned was 14-15% returns. Mm-hmm. Good mutual funds add 3 to 5% alpha. Investors deliver 18 to 20% long-term returns. Account statements of investors, if we analyze, would be 6 to 7%. So this is a classical behavior gap, and this is primarily because investors always invest when there is comfort of investing, and comfort of investing always comes with peak valuations. Right. So the learning I had when I joined IDFC, and IDFC was a 10-year organization by then. IDFC already had built this ethos that if we have to be relevant in the fund business in India as a young entity, it will only happen when our investors make money, when our investors have good experience. And in spite of all good intent, investor experience never tends to be good because of the greed and fear hypothesis. Yeah. And these behavior biases are, wired through evolution, and in a way they are God-made. Yeah. So however much you attempt to educate, it's not very easy to remove these biases. So changing consumers is not easy. Changing ourselves or our design or our product design is easier. So IDFC, when it launched its equity business and one of its flagship fund called Premier in 2005-06, came with that concept that we will raise money when there are more investment ideas. Yeah. By definition, more investment ideas are available when it is not easy to raise money. Sure. And vice versa. And we will not raise money when the market gets fragmented. So it's been a build-up on that hypothesis, on those principles. And we've tried to, make that a DNA of the organization and transmit that to our distribution partners and to our investor community.
So, Mr. Parekh, when somebody is hired at your organization, how do you impart this culture? Because invariably he would be coming from some of the other AMC only, where this would not be the culture, isn't it?
So, unfortunately in our business, the AMC business has always got bad press. However, collectively on an average, the AMC industry has created a lot of value in terms of long-term compounding, and some of our good fund managers in both the asset classes, debt and equity, have created huge alpha. The right messaging has not reached consumers. So I won't say that, IDFC alone is good and others are not. I think a large part of the fund management community has the right intent at its core. Sure. But the assumption made is investor beware, or investor will be aware of market cycles. Or the assumption is that over long periods of time, it does not matter. So if you have a 10, 15, 20 year investment horizon, a good stock selection overcomes market cycles and continues to compound wealth. What does not work in this assumption is the first part, which is investors will invest for 10, 15, 20 years. Historically, when we analyze data for last 15 years, we've seen that the average age of a mutual fund investor in an asset class is roughly 2 to 3 years. And
wow. Okay.
What has tended to happen is because of wanting to buy past performance, money comes in at a performance peak cycle, and typically the next 2-3 years are not in line with expectation, and investors lose patience and move out. And generally after they move out is when the cycle turns again.
But leave alone that, Mr. Parekh, not just 2-3 years. I mean, it has been statistically proved that if you buy at a wrong time, sometimes you can wait for a decade, and the opportunity cost loss can be huge as well.
So I think, like I said, in India, at least my observation in last 15-16 years is that, take the classic example in recent times of 2008 to 2013, market peak to market peak.
Yeah.
Markets went nowhere, flat, no returns.
Right.
A lot of funds, including IDFC funds, doubled their NAVs. So they compounded.
Right.
They compounded at 15% CAGR, which is a very credible return when markets went nowhere.
Sure.
And that's what I'm trying to say, that there is a lot of alpha generation that does happen in fund management business. However, 5 years itself is a tenor which we do not get from our investors because of the 2-year, 3-year cycle.
Sure.
So there is a 2-year, 3-year itch.
Right.
When the money tends to keep moving out, and money starts chasing another asset class which has started doing well. So the basic discipline of recognizing that investing is for decades is missing. We do hear that this is a very purist concept. Only Warren Buffett can do it, etc., etc. But I think my point of view always is that if you want those returns, you need to earn it. You can't get it with 2 or 3 years of investing.
True.
It's a difficult message to give. We continue to pursue that.
One question I have is, has the, this cyclicality, if I may use the word, in the inflows and outflows of the mutual fund industry, has that in any way led to, let's say, demotivation in the fund managers themselves? Because when they want to manage good money, they don't get the money.
Yeah. Absolutely. I think I agree with you. It does lead to, what tends to happen is real long-term alpha happens when you are able to build a portfolio with that type of patient money.
Sure.
Right.
But if we don't get patient money, you can't really deliver what you are meant to deliver and what you're capable of delivering.
Mm-hmm.
So the balancing act of managing short-term cycles yet delivering long-term superior alpha is not very easy. I empathize with great quality fund managers who have to blend these two together and still keep delivering their best.
So the redemption pressure would come exactly at a time when
vice versa, inflows will come when it probably is not the best time. So one school of thought is that do not time the market. Invest every day is a good day to invest if you have the right time horizon and if you are buying the right businesses. There are only 3 things that matter. At what price do you buy, or rather at what valuations you buy? What do you buy, which is good companies or bad companies, and for how long do you buy? Now, how long is not in our hands. We would love to buy for long, but that luxury is not there in our hand.
On the contrary, I think it goes absolutely reverse. Yeah. So the moment you see losses, you tend to take the money off the table. And that is
so it's a difficult dilemma, but I think the industry is also evolving. Customers are also evolving. There is a breed of, lot of investors who recognize these realities and who... And I do give a lot of credit to the industry that there's a lot of emphasis over the last 5-6 years on monthly investments. The basic premise is you can't even predict valuation cycles. Valuations can remain extreme both sides for longer than we wish. So the best thing to do in the formula of compounding is how much time you can give and how much money can you save every month.
Right.
So rather than timing the market, keep saving every month.
The SIP concept.
The SIP or the STP concept. You will average out the ups and downs of the market, and it is not the most efficient solution, but it is probably the only solution which will take care of 95% of the investor base.
Right.
It will not end up over allocating money in expensive markets. It will not keep the investor out of the market when valuations are very compelling or investment opportunities are very large. And SIP ensures that you are continuously participating So it's a discipline, it's a process. And end of the day, either we manage a process at our end, which we do, is an overlay of the discipline that the investor also brings in. So in the last cycle, we saw in 2009, 10, 11, when markets corrected and were going nowhere, a lot of SIPs started getting stopped. Investors lost patience midway after 3 or 4 years and they stopped their SIPs. But in this cycle, I've seen, and I give a lot of credit even to a lot of advisors who worked hard on the discipline part. There is an emergence of a concept called perpetual SIP.
Yeah.
So the SIP form is up to 2099.
Okay, interesting.
Wow.
It's not longer, but I think the system cannot take it beyond that.
Okay.
So if I want to do a 100-year SIP, I can't do it.
Okay.
But even 2099 is more than the average age of an Indian. So a lot of investors have at least taken that route, and it's a behavioral nudge to start by saying that do a perpetual SIP.
Definitely.
If the investor says no, that's too long, okay, do a 10-year SIP. In old days, we would start by putting 1 year, 3 year, and 5 year,
Right.
and the propensity was to take 1 year.
1 year.
And there is one advisor who flipped this without, he's not an expert on behavioral science, but with a lot of common sense and wisdom, he said, let's not put 1, 3, and 5. Let's start with 10 years or above.
Yeah, this is typical Dan Ariely's experiment
Exactly.
on contrast.
Absolutely. So that's how, we have learned. And in this cycle, a lot of money. So to give you a sense, roughly around 600 crores a month comes only on SIPs every month.
Amazing.
This must be a huge jump to the previous numbers if I'm...
So it's still not a large number in context to the total size of the money. So on an average in this cycle, in the last 18 months to 2 years, the average inflow has been around $1.5 billion by mutual funds. So between 6,000 to 9,000.
Compared to previous cycles?
This amount?
Yeah, this amount.
So in the previous cycle, it was 3 to 4,000 crores. So in this cycle, the quantum has gone up to 2.5 times. Even the SIP quantum has gone 2.5 times. And the SIP numbers continue to increase. I think SIP has become a norm now. People are, recognizing that that's the best way to start investing.
No, but there have been a lot of efforts by advisors plus AMCs to teach them also.
See, even, there is a lot of skin in the game for advisors. I'll give you another anecdote. 98, there were a couple of funds in that correction which were at an NAV of 7 rupees.
Okay.
Now, 98 to 2015 is roughly 17, 18 years.
Yeah.
At a 17% CAGR, that 7 rupees has become 700 rupees. 100 times.
Nice.
18% CAGR. Because, a lot of funds have generated 18 to 20% CAGR.
Okay.
So if as an advisor, I had 1 crore of my client asset, and if I was able to just hold him through, it would on its own have become 100 crores.
Wow.
Mutual fund is the only product in the world where you earn not just on the capital but on the portfolio value every year. So on an average, let's say the trail income those days was 0.5% of the portfolio value. So if you were earning 0.5 on 1 rupee then, today you would be earning 0.5 on the entire 100 rupees every year.
Interesting. Wow.
So there is a maths which says that if you are a seller of a mobile, you will get a certain percentage of the value of a mobile.
Yeah.
Mutual fund is the only concept in the world where you can get more than the value of the product sold if your horizons are long. So the compounding works for the advisor also. And I think there are enough smart advisors in India in the unorganized distribution segment who run their own shops who realize this, that it is in their interest to build a long-term AUM which can compound because the incomes will accordingly grow.
Talking about advisors, one thing which I observed and some advisors I had communication with also, I've noticed that IDFC does not have that kind of a, incentive structure which a lot of other AMCs tend to have. So I should say some crazy offers and crazy incentives given to a lot of advisors.
Foreign trips and whatnot.
But on the conditions, how does that lead to advisors not shifting loyalties, so to speak, or does that really create a problem for you to keep the advisors?
How do you keep
more
them
focused,
motivated?
More focused towards selling the right product and not going towards their incentives, or they themselves are able to manage it. So
it's not easy. It's challenging. What we have tried to do is ask this question: that is this an asset management business or an asset gathering business, and what do you want to really aim for? The purest argument is it should be only asset management. My point of view is that you can't manage assets without gathering assets. You need to first gather assets. So if you are able to gather assets at the right time and then manage it well, long-term growth and long-term compounding can happen. So that's been our attempt. It's a long-term story. It may not give results in the short term. I don't have any bias against incentives or foreign trips, etc. if they are productive and if they lead to incremental value addition. So our attempt always has been, in the last couple of years, what we've said is the biggest gap is understanding the nuances of investing, but more than just understanding market cycles and asset class like fixed income and equity. Another element of learning is human biases and behavioral biases. And the fourth thing is we are end of the day in the business of relationships and dealing with human beings. So the element of selling skills and soft skills becomes important. So we have tried to allocate more resources and incentives around bringing these skills to our advisors.
Right.
So in any industry, there is a community, there is a distribution community, and different people align with different incentives. So our bias has been to align with advisors who value a lot of these ideas and enablers. So we have adopted a strategy as follows, that this is a category which is the best way in which Indian individual investors can invest. So those who understand stock picking should do it on their own. But I can guarantee and bet on this that number will be handful.
Right.
There will be many who have an illusion that they know stock picking, but really knowing stock picking will be very few. It's not an easy art or science to learn. So the most disciplined way of investing is mutual funds. So as a product, its superiority is unmatched. The penetration is 4 or 5%. Or rather, the penetration would be 15% if I take the right universe. So I'm not considering 100 crores of Indians.
Right.
If I assume that people who have meaningful amount of money to save, it would be 15 crores. We have around 1.5 crore investors who invested. So we still have 10% penetration. So the debate always is, in a 10% penetration industry, do you do price wars or do you focus on volume expansion and give enough skills and tools to distribution partners to go and expand the market and build the market? That has been the thought process of our entire distribution strategy. And
following this route, you invariably save yourself from the perverse incentives of mis-selling.
That's the other point, that incentives or they create behaviors. So our attempt has been to become more aggressive on incentives again when we feel the timing is right. Because it is a reality that incentives will drive behaviors. It's not right to say that good incentives are bad, but incentives timed well make a difference. So we have attempted, so I won't say we've been defensive, we have been equally aggressive, but we choose our timings.
On the same line, so on the timing part only, I was just about to ask you that the major selling happens at the peak when people are more willing to give money also, and for the advisors the major business also would probably happen at that time, and that is when you guys will say no NFOs, right? So how does the advisors react to that kind of
So I think we lose out on a segment of the market. So in a 100 rupee pie, we probably will lose out on 30-40 rupee pie. The pie for us naturally then is 60 rupees. Okay. And we try to say that let us try to do the best in the 60 rupees and be more relevant and more dominant. So has it worked? Really, honestly, it's not yet given me the results that I would like to see. It's a long haul. We don't want to give up. We think we continue to try, and over cycles the market will realize. So what we like is, advisors recognize this DNA, this character, and they know that, okay. So the right advisors end up aligning with us. All advisors may not end up aligning, and then we have to look at different strategies to try and reach out to them. But it's work in progress. I still don't have perfect answers to this.
It's very interesting that you said that, Mr. Parekh, that the right advisors align along, because I read this in one of the annual letters of Warren Buffett, where he said, because of the policies that I follow, all the right shareholders align with me. Yeah.
Okay, so Mr. Parekh, I have just, so you have given this external environment related decision making picture, pertaining to the advisors, pertaining to customers, pertaining to competitors. But have you internally faced some challenges to come up, to take such decisions which have been pretty unconventional, even to educate the investors to a level where you have been doing now? Have you faced internal challenges in any way in terms of decision making? So people against the idea, or people resistant to start with the new idea,
or maybe not even able to understand it.
So I'll tell you, like I said, I am an outcome of IDFC's philosophy and thought process rather than the other way around. Okay. This has been a thought process which was born in the IDFC group and IDFC Mutual Fund. And even, before we were IDFC Mutual Fund, we were Standard Chartered in early days. So this has been an ideology, always been there. I have, I have joined them 10 years later and got immersed in it.
Right.
So today, if I have to think of working in any other format, it would become very difficult and challenging, because this gives you a lot of satisfaction when you go back home, and peace of mind that yes, you're doing something different, and not just different but right.
Yeah, it's a good strategy to keep the people also with you.
Yeah, in fact, I was having conversation of a couple of IDFC employees, and this is precisely what they told me. They're like, after IDFC, I don't think I can work anywhere else.
We have a career crisis at hand. But so when you ask me what are the internal challenges, thankfully we are a board-run company, and most of the senior team members and colleagues are all aligned around this. I think everyone in the organization says that this is the only way we can work, because we think this is the right way, and if we execute well and right, we will achieve our pound of or our share of the rightful side of the market. But there are times when, times like last year, when you have to lose market share, you end up losing market share. Board members or shareholders obviously question. But so far we have been fortunate that every time we've gone to the board with a thought process and logic, they have backed. On the other hand, I also think that if we still execute well, we can still grow doing the right things, because there is enough money at the middle of the table than playing on the sidelines. So our whole effort is how do we improve our execution, improve our processes, and reach out to more people. So
sticking to the value, as you said, of IDFC. In my investment career, I have been privileged and lucky to talk to a lot of CEOs and leaders. One thing which I've noticed, and they have often mentioned, that the vision of the top guy, the CEOs or the top management per se, the vision of the top management sometimes is not resonate. It doesn't resonate with the organization at the absolute bottom level, right? Now, and especially when the vision is an unconventional vision as yours. Now, how do you ensure that, first of all, is attrition a problem for you guys? Because of the very nature that it will be difficult for you to hire people from other AMC because of the cultures, if at all, I'm not really aware. And secondly, once you do that hiring, how do you keep them? So is attrition a problem you face, first of all?
So attrition is not a problem. Hiring sometimes is challenging.
Okay.
There are, in a country of 100 crore people, enough talented people that you find. What is important is to get the right alignment and the right people for this type of an environment.
Sure.
So, good talent in a different platform may not really be successful in a framework like this. So what we are very cautious and careful about is who do we bring on board, and we take time to judge if a new incumbent will succeed in an environment like this. So the thought process that is required, or the skills that are required, the filters that we put are slightly different. The filter required here is more of innovation, more of market development, more of knowing the underlying asset classes really very well, and a lot of emphasis on soft skills, a lot of emphasis on knowing the domain very well. Most importantly, having the mental strength to realize that this is the road less traveled and not going to be very easy. So very clearly in our selection process, we highlight to people that this is the way we operate. The other pros and cons. This is why we like to work in this fashion. But this is the downside of this approach, and we try to look for fitment in context of this strategy. But we also are very transparent when we do the hiring to say that this is what you will face. So it should not come as a surprise. The bigger challenge that you face at times is also the morale of the team, because what we look for is people who are having a very high achievement orientation, and a team of high achievement orientation at times when does not get desired results. I don't need to tell them that numbers are not good. They on their own realize and tend to struggle. So a lot of my guys have shoulders dropping momentarily in periods like this. And here is where then the internal communication and hand-holding takes over. So a lot of time we spend in continuous learning and development on some of these concepts. I personally feel that these are concepts not yet tried out in the fund industry, and we have been pioneers. So concepts like behavioral biases, concepts like soft scaling, a basic concept of simplicity. I've always believed that the fund management business or industry tries to talk complex languages with an illusion that it will make us stand out. But we actually stand out, and investors also stay away. It excludes us from large number of customers. So, in fact, 4 years back, we internally launched a campaign called Simplicity, that can we simplify as much as we can.
Very interesting.
So we still are, let's say, 30 or 40% in that journey, and a long way to go. A lot of effort has been made to simplify concepts, demystify concepts like showing risk first and not showing returns.
Okay.
We've used the concept of movies to transmit ideas.
Yeah, the 180 one you also launched.
So we first made a movie called Bachat Nivesh Badhat, which talks of 3 households in India and their styles of saving or spending money, and then the smart way of doing it. One idiot was IDFC Foundation initiative in that concept of nation building, that if we are really able to make youngsters realize the role of money and respect money just when they earn money. Most of us, including myself, in spite of being in the fund industry, the first 10 or 12 years, I was fairly reckless in my way of investing. So in a way, it was a loss of 12 years of compounding.
Sure.
So I think if we can really just get investors to start on the right track right from day one, it will make a huge difference. So one idiot is another example. Then through our distribution partners, a lot of product ideas are transmitted using very innovative sales tools and concepts. On our website, we have a section called "Is it a good time to invest?" So it's a traffic signal which is a reflection of valuation. So currently it is flashing red because valuations are expensive. But it says that typically when you invest in high valuation markets, the near-term future returns tend to be muted. So if you want to really earn respectable returns, you need to extend your time horizon or rebalance your asset allocation. We are making a lot more changes on the website where we can show in any of our fund what was the worst return in its history for a defined time horizon.
That will be something different.
The idea is to make investors know what can go wrong.
Sure.
Because my experience has been that whenever investors have invested in our beautiful category of mutual funds, they have only bought the upside without knowing that to earn that upside, you cannot not get the downside. There is no way in which I can give you 20% CAGR without having
potentially
the drawdown.
One drawdown of 20% or 30% or 50%. You have to live through that. You can't be just plain lucky to get only the upside. So if I'm able to upfront show that these are the downsides, but the price of this downside is this upside, now you choose whether you want this or you be happy to invest in bond funds. So we also have bond funds. Mutual fund industry is perceived to be only an equity category.
Right.
We are making a lot of effort to make people realize that it's okay if you don't want to buy equities. People who have a lot of wealth do not need wealth creation, perhaps. Even wealth preservation with tax efficiency is a great value add to them.
Sure.
So today people are queuing up to buy 15-year bonds at 7%. We have actively managed bond funds which in the last 10 years have given 9 to 10% CAGR tax-free with liquidity available to you every day. So the whole idea is to bring that awareness and then enable investors to buy rather than sell to them. So if they buy it, the ownership is better. And if they buy it with awareness, I think the job is done. The challenge is to build that awareness because investing decisions are done very, very quickly in moments of greed or fear. It's not a very cold-blooded, rational decision making. So even on the website, you barely get 3 or 5 minutes of the customer. So how can we crunch our messaging creatively, keeping it simple is the attempt.
Now, just one question on the marketing front only. You mentioned that it's the communication from your end that takes the priority, and you tend to make it more long-term focused. But and it's a observation rather than anything else, that a large number of people, they take decisions of investing with the AMC on the basis of the image of the fund manager than the communication of the AMC per se. So do you feel that in that regard you have been able to break sort of a ceiling, so to speak, that the people appreciate the communication and not only go with the fund manager image or anything like that?
So I think in investing, fund manager makes a lot of difference. Who manages your money determines what outcome you will get. So while it is very fashionable to say process is what rules, but the process is also institutionalized and executed by the person. So if you don't have a right process without a right person also does not lead you anywhere. So it's a blend of both. There is a constituent in the market which necessarily relies on the fund manager and gets more comfort around who the fund manager is.
Right.
So we've been fortunate to have some of the best talent in the industry, whether it is on fixed income and in debt or in equity. The other point to look at is that it is a 10% penetrated category. 90% people don't even know that mutual funds exist. Right. So it doesn't matter to them that this is a good fund house with a great fund manager. It is futile to them because they don't know about our existence. So it's a balancing act. To those who need the role of fund manager, you can't ignore. It's a desire. So broadly in our existence of 15 years, we've had very good talent who has not only delivered but has been able to position the platform in a very credible manner. So far we've been fortunate on that front. But can you completely eliminate that through communication? I don't think so.
But you said 90% people are not aware.
Yes.
How do you ensure to get that inclusion? I mean, what is the strategy going forward for you as well as the AMCs for that matter?
If we knew, we wouldn't be at 90% gap, to be honest.
What's the strategy going forward?
I always reflect that when I started my career, penetration was 7-8%. Today also it's around 10%. So it's really, there's a lot of randomness in the growth of the industry. Industry grows when the asset class does well. We at times get this illusion that we have really made a difference. Right. So you will see a lot of self-congratulation and patting on the back in the last 1 year that equity assets have grown and stuff like that. But the industry should be worried because if they have grown at 20 times and above valuation, what will the future experience be? We don't know. I think the need of the hour is continuously educating and creating access easy. So there have been challenges, but I think the way India is transforming from a digital perspective, and even SEBI recognizes that the only way to really make mutual funds inclusive and accessible to the last man in the country cannot be through a physical pipe, cannot be by opening 1,000 offices in 1,000 cities. It's not profitable, it's not scalable. The best way is the digital route, and I think in that context India has taken a leap where 35% of the population is on smartphones. So people who really matter to us, almost 100% of them are on smartphones. And I think over time, probably very soon, a lot of changes will happen in the process of investing, which will make it very simple. How well we are able to capture this digital evolution, along with building a community of advisors who can handhold and sell right, is going to be the outcome. So our focus is to build a quality distribution, partner with them, and from a digital front, be very relevant by making access simple and talking a language that consumers understand. So I think if we are able to break the barrier of complexity, so our effort continues to be around breaking this barrier of complexity and making people really understand what we are trying to say.
Just out of mind, I have this point that just flashed. Can there be a collaborative effort by the AMCs to, do something like this? Do you think that's possible, first of all? And
it's a hyper-competitive industry, anyways.
Okay.
I haven't seen of any category where peers collaborate, but I think to give credit, In the last few years, a lot of collaboration, knowingly, unknowingly, has happened around the broad messaging of investing through SIPs, the broad messaging of mutual funds being relevant.
Right.
SEBI in the last couple of years has pushed the industry towards collaboration. For example, there is a budget created which is meant purely for investor awareness education. So a lot of communication in the last few years from different AMCs has been happening towards making mutual funds more understandable and accessible. SEBI itself has been doing, AMFI and SEBI have been doing separate campaigns. All of this has been supported by rising prices of the underlying asset classes. But I think what remains to be seen is how well do these lessons stick when the cycle turns, and are investors able to last a cycle of no returns for some time. If I think we are able to cross that, we would have seen some amount of maturity in the industry.
Okay, so next question I have in my mind is about your style of, managing people. Now, Warren Buffett is famous for saying that we delegate to the extent of abdication. So, what is your delegation style? Where do you draw a line between, let's say, micromanaging, be it advisors or be it your own employees, and leaving a free hand for them to? So, where do you draw that line? Is it only to the communication point, or how do you go?
So,
about it?
we run a very lean organization across all functions. And our total team size is roughly around 130, 140.
That's it, across India?
Across the country, across 40 locations that we are in. And so in contrast, similar sized organizations would be 2 to 4 times bigger than us. What we've tried to do, like I said, a lot of time is spent on getting the best talent and then nurturing and grooming them. Over the last 2 years, what we have done is we invest heavily in the first 15 days through a very intense induction program, which is not just a theoretical induction program, but which really imbibes everyone with the DNA and with what we want to do, so that when they go back into their market, they are able to carry the message of the organization, and they can face the market or they can face challenges knowing that yes, this is what we stand for. So a lot of effort is done to build talent and even to hire the right talent. At times you interview 30 people to get one position filled up, but we don't mind because the number of people, we barely have 8 to 10 recruitments to be done in a year.
You said 140 people in 40 offices. That boils down to 3 people per office on an average.
So typically beyond the 8 metros, it is 1 person per office.
Interesting.
Because end of the day, a lot of our business is done through our distribution partners, so we really don't need to stretch ourselves.
Sure.
And a lot of our process-oriented work is outsourced to our registrars and custodians. So that's a more lean, cost-efficient structure. But coming to the question of delegation, I think a lot of delegation works because of the nature of people and the talent that we have. So we run a very flat organization. For example, there are very intelligent sales guys on the ground who report to a regional head who report to me. So very flat hierarchy.
Pretty lean.
Yeah, and I think we've been fortunate to get some of the best talent. So I can say with pride that this is probably the best team I could have got. So another challenge of working elsewhere is to build a team of this profile. Yeah.
One thing I can pretty much say with a lot of conviction here, that whatever my communication has been with your team, I think the feeling is pretty mutual there.
Yes.
They
in fact,
appreciate
I was having a word with Navneet the other day, and he said Mr. Parekh gives us a free hand, and we're literally working here as entrepreneurs. And
so that's been so again, I don't take credit for this. It has been the thought process and the DNA. And one thing that I have also learned after being a part of this organization is the only role I need to play is when I can be an enabler. Otherwise, let them operate. So my job is to ensure that there is a proper platform and all the enablers are in place. If they need anyone from the corporate office, we are there for them. But we don't interfere or, the benefit of a flat organization is there are very few aggregators who need to call every day to ask, aaj kitna dhanda hua? So we don't ask these questions because that is something the system gives us every day. So we have a system where the sales team only tells us that today this is what business we've done. It's bottom up rather than top down. And the whole idea is hierarchy should add value, not act as a deterrent in their daily job by asking wrong questions. The question to ask is, how can I make your working better? How can I help you achieve your targets better? I think that framework works well. Also, productivity is far better when there is freedom to execute, and it builds more ownership. Guys feel that yes, this is my. So what we tell our colleagues is, each one has its defined group of relationships to manage, whether it is institutional investors or advisors. You are the CEO for that business. You have all the tools, all the budgets, all the resources to manage it. If you need us, we are there for you. So a lot of ownership is transferred.
This is profound, Mr. Parekh. I tell you why. Another correlation with Warren Buffett's way. Their Berkshire Hathaway has 15 people in their headquarters, and like he started with the question, they basically delegate to the level of abdication.
Yeah,
pretty interesting.
You said one thing that there are times, bad times for the mutual fund industry when your employees, the shoulders drop and there's a lack of motivation. Just out of curiosity, have you ever questioned the whole method yourself? I mean, was there a doubt at the level where you thought that probably this thing is too radical or too unconventional, that it might not work? I mean, or it could be like...
I slightly disagree in the sense that this is not too unconventional. This is the right thing to do. And see, like I said, there is one part of the fund business which has a lot of cyclicality in it. So out of, let's say, 13 lakh crore AUM, 3 lakh crore AUM has cyclicality, or 4 lakh crore. So that's 25%. Okay. There is 75% of the fund AUM which is in fixed income, which does not have as much cyclicality, which gives you straight line returns to a large extent. There are money market funds which grow every day at the money market rate. Right. So if this part of the platform has challenges or headwinds, there is something else which tends to do well. And the way we think is, we are a supermarket. We have enough products. So we have products which can fulfill your investment need from one day to a lifetime. Right. And depending on your risk appetite or your preference. So enough products are there to be sold in every market cycle. In that context, even in times when, let's say, selling equity is difficult, there is something else. So for example, this year we told our teams that probably fixed income is more relevant, more attractive from a risk-adjusted return point of view. We have very dominant products in that segment. Feel free to sell more of fixed income. So, and like I said, the pie is too large. There is a lot of money. What we need is more creativity to find newer markets, newer customers, over and above doing the penetration.
Understood. Got it. So let me now let's get to slightly hypotheticals here. In a world where, let's say, you are given a completely free hand, how do you see an ideal mutual fund industry where you have absolute free hands? Let's say you can do whatever you want to without any constraints whatsoever. What is your vision for that ideal mutual fund industry? Let's say.
Yeah, I think it is a very hypothetical question, and I can't imagine in a hypothetical world because it's not reality.
Yeah.
It's futile to really imagine something like that. We try to find our own ideal approach in a real world. It's always...
Then, let me change the question. In the constraints you operate in the environmental constraints you operate in, where do you see the industry in probably the best possible way going, let's say, 10 years from now?
So if you ask me honestly, we don't. Everyone operates in some constraints or the other. So to even demand an unreal world or a world without constraints is futile. It's not pragmatic. And hence there's no point in evaluating or dreaming about that.
Right.
It's better to know that there is a reality and we all have constraints. We have to find the best way. I think the opportunity is so large for us in terms of knowing that India is a young country. Per capita is growing. Money in the hands of Indians is going up. Indians are traditional savers. So they need savings solutions and options. It is a country with better literacy and better technology adoption. We have the right products. What today we are missing is the link between the two and the channels. a lot of work needs to be done on channel development and creating access. And I think in an ideal world, I would want to get that access grow. So the pipeline which connects the investment world to 15-20 crore consumers, whether it is advisors, whether it is a digital route, is something which needs to be built. What I would look for is some amount of regulatory realism on making the industry more simpler. So it's unusual. We look for simplicity, but our offer documents are 100 pages long. So what can be done in 3 pages? So it's very simple to say that if you invest in mutual funds, the worst experience you've had is 60% fall in NAV in 1 year. Versus that, there are 30 pages of risk factors and disclaimers which even I don't understand at times. So some amount of realism and practicality in making it simple. I think the biggest barrier is complexity. Otherwise, Indians are worldly wise. They understand the role of savings. They understand the role of money in their life. They understand that they need to be disciplined to fulfill their future goals and dreams only through disciplined saving. The mode of saving today is not the most efficient, either from a taxation point of view or from an inflation beating point of view. So ideally, that ability to simplify the message can go a long way in making consumers realize the role we play. So look at it the other way around. India is an inflationary country. Every year you lose 8% of your money.
True.
So left to itself, the money will die poor. You keep losing value. On the other hand, India also has a lot of growth, and equity has compounded at meaningful rates. We just need to marry the need and the solution.
So, do you see the equity investors or investors in general appreciating this point nowadays more than last,
yes.
let's say, 5-7 years?
I think there is a significant amount of awareness being built. A lot of new investors are coming through the SIP route. New business models will evolve. For example, funds will get created around goals, around basic needs like retirement or children's education. Our business model is different, which is take money when you make money. So I think a lot of new practices will get developed very quickly. So the rate at which transformation has happened in the last 10-15 years, it won't be the same. You'll see things moving at a much faster rate.
So maybe we are at the cusp of equity.
I think so.
Being
I've always said that after having worked over the last 17-18 years, is one thing that the fund industry should not have is obsession to an asset class. Why should an 80-year-old who has enough money to sustain go into equity, lose money and then go out? It's okay to sell a bond fund.
Well said.
So I think the industry is obsessed around equity, which is why the perception is mutual fund is equal to equity, is equal to casino, is equal to risky.
But has it something to do with the incentives? Maybe there are more incentives in selling equity.
Not anymore. Fee structures are very similar. Payoffs are very similar. The new trend of regulation, the way it is going, and if it happens, it could be transformative again from a behavior perspective. Is the emergence of investment advisors, where they don't take revenues from us, but they say that my employee is my customer, he will pay me my salary by giving me fees. It's a very ideal long thought, but at some stage, that is a new business model that is evolving. A lot of bankers are quitting their jobs and becoming advisors.
Yes.
A lot of young quality advice IFAs are emerging who are taking that model. A lot of technology platforms are coming, which are giving all the right tools and techniques and technology to run a business model efficiently, where the role of the advisor is only to acquire clients and manage relationships. So, like I said, we don't need an asset class obsession. We need a consumer outcome obsession. That
but you also mentioned that for this to happen, the asset class knowledge has to grow. Don't you feel there's a problem there? Because the people you are trying to get to the knowledge of the asset class are essentially marketing people who are more equipped with the selling part of this skill than the understanding of equity or maybe any other asset class.
I agree. So I take your point that unlike selling a soap or basic lifestyle product where the damage can't be too high.
Yeah.
Right.
In financial services selling, the need for responsible selling is much higher, and the need for the right skill sets is much higher. And which is why, like I said, our whole emphasis in a distribution building or partnership is around building these 4 pillars of knowledge. So, our distribution, learning and development strategy is only around 4 things. Learning of equity market cycles through a game called Equity Bazaar. Learning of fixed income trends and fixed income variables that determine how interest rates and bond funds behave through a game called Macropoly, which is a design around monopoly. The concept of, so you may be well equipped with these 2, but if you can't overcome the behavioral biases of consumers, for that we have a concept called Behave Yourself. And the last one is soft skills of learning how to understand your consumers and their style is through a concept called ISEL. ISEL.
Okay.
Internally we call it the IDFC way of selling.
Okay.
So that has been the driver of imparting relevant knowledge to make our channels and our own sales teams very efficient. So the point I'm making here is you don't need a sales guy to be a fund manager. Also, and you also don't need a fund manager to be a sales guy. So you also see, it is very unfortunate. People want to see and hear the fund managers more often, without realizing that if they are seen or heard more often, when will they manage money?
They'll do the real job.
On the other hand, there is a lot of. So you asked one question that what would be an ideal world? I would want an ideal world where a salesman is a blend of understanding basic investing concepts.
Right.
That what is the basic of making money over long periods of time, role of discipline, role of asset allocation, role of the concept of margin of safety, understanding consumer behavior, understanding marketing, so that you can simplify technical concepts and talk the language of consumer. So the whole orientation needs to be outside in. So for example, how do I tell the customer that valuations are expensive? So if I use my conventional language of price to earning multiple is so and so, it won't connect with the consumer. So how do you convert that in a simpler language and explain? Becomes the key role. So the fund management part manufactures the product with discipline and create long-term compounding. The role of the distribution and marketing teams is to magnify that message and ensure it gets broadcasted to a larger number of people in a simple manner. So a lot of effort needs to be done to make the sales channels more disciplined, more proficient in the underlying domain. The other question to ask is how many people who distribute our products internally, which is the sales guys, and outside are themselves becoming rich. So if I'm claiming to make you rich, first of all I need to demonstrate that I am able to do it. So I think
famously Warren Buffett said that Wall Street is the only place where people
go in
limousines come to
take advice from the people who come
subway. So some concepts are very elementary and basic, like concepts like asset allocation and SIPs. You really don't need to know too much of market knowledge. So one school of thought is basic products and ideas can be sold by large distribution scale, and evolved products and complex products can be sold only through limited segments and channels. But clearly there is a big vacuum in terms of bringing in more knowledge to our own teams within the industry.
But besides the communication part or the concept part, do you also think that there is a lack of quality data or information points where people who want to directly get involved into equity, for that matter, they do have the dearth of some kind of a call? Like in US, we have a lot of companies giving good quality data information. Do you think AMCs also can get into that kind of stuff, or do you think direct equity investing should be something which is...
So see, I think 10 years back this would have been a valid argument that data is less available and whoever has data or information has an edge. Today there is an overload of data globally, or and enough platforms are emerging which give you data to analyze whatever you want to do. I don't think the issue is data. The issue is how do you interpret that data? How do you control your greed and emotion? How do you stay disciplined? And I don't think discipline can be taught.
But interpretation can be taught.
Interpretation can be taught.
Yeah.
So one can teach how to invest in equities. I do not deny that. Probably an individual investor can outperform mutual funds over long periods of time because it does not have these challenges of constraints of daily NAVs and all that. So we do try to overcome that by creating products like Premier where we shut subscription, etc. But the bigger point I have is how many people have the DNA to understand equity. Are they going to spend time reading balance sheets or doing their primary research?
Sure.
So it's better to give up 2-3% extra return or 5% extra return. You may not earn 25% by not doing direct stock picking. You may earn only 15%. That's good enough. And not because I'm wearing the fund hat, because the cost of trying to earn 25 with half knowledge is probably -10 or -20. So the point to ask is for a large mass of population, which is the best way. And I think if everyone learns equity investing the right way, equity returns will be equal to fixed deposits.
That is absolutely correct.
That is very true. Okay, so I a few things I have to ask you. First is, I have noticed that you are nowadays reading more, because I follow you on Twitter, and you have tried to educate your readers via Twitter also by quoting a lot of Intelligent Investor from Graham. And so what are you reading nowadays, and how has been your reading journey? Are you an avid reader? Have you ever been an avid reader?
I'm an erratic reader. So when I meet people like you, I try to read a lot. Before meeting people like you, I would want to read a lot. But it's not very disciplined. My reading starts late in the night after putting my kid to sleep.
Okay.
And I've started now trying to write down what I read if something makes sense.
Interesting.
So my reading is first about learning the concepts of investing in different styles and different market cycles, different investment managers, their principles. To realize that there's no one holy grail, there are different routes to heaven. That's one part of my reading. The second part of reading is how do you convey this to the common man? It's not easy. So you may have the best of knowledge, but if you can't transmit it, if my population understands Hindi and if I talk in Greek, the best Greek will fail.
True.
So how do you? So there are a lot of books which help you in converting investment complex language in simple sort of concepts. So that's another area. There are I like books by Nick Murray, for example, who is a very well accomplished advisor in US, who converts these concepts into very simple things which only matter and cut out the noise around things that don't matter. So that has influenced a lot of my transmission, and I tell my teams also to learn these principles, learn these concepts.
Sure.
So something very relevant for India, for example, is we are a fixed deposit loving country because we like certainty. So we give lots of money to good banks and bad banks at 8%. And they give lots of money to good and bad promoters at different rates of return.
Sure.
Right.
And a lot of these promoters earn 15-16% return. So there is a 8% transmission loss.
Sure.
So he has one very nice line which says, do you want to be a loaner or do you want to be an owner? So by loaning your money, you earn 8%. But by owning, you'll earn 15 to 16%. So the basic concept of debt and equity explained through very simple, powerful
So he understands the
statements.
Communication has to be in the language of...
In the language that
simple
we
and
speak, that we understand. There's another very accomplished guy in US called Carl Richards, who just sketches on a napkin most of these concepts.
Very popular.
And one thing which is most memorable is two circles, one which says what's in your control and the second one which says what matters. And anything which is a part of the overlap is what you should focus on. Everything else is irrelevant. So China में क्या होगा? Why discuss? US Fed hike कब करेगा? Janet Yellen को भी शायद पता नहीं है. But we end up spending most of our time doing that. So some of these guys may not probably understand balance sheets or valuation, and they say it doesn't matter.
It doesn't matter.
There are specialists who do that.
Right.
Them knowing it is important. How to use them is what we need to learn.
Sure.
So if there are great money managers in India, how do I leverage or benefit from them is what we need to learn, and help our investors learn that.
So what are you reading currently? That question remains.
Okay. So currently I'm reading his book called The Game of Numbers, which is about the art of selling and the art of overcoming objections.
Okay.
I almost every month read The Intelligent Investor to refresh basic concepts.
Okay.
I think these two books come immediately to mind, but I do read a lot of blogs now because they are faster, and there is this realization that even in most books 10% is the juice, 90% is repetition.
That is written to make it a book.
Yeah. So it is written to make a blog a book. So you rather read the blog. So I think Jason Zweig is one guy who influences. He blends long-term market, cycles and information and behavior very well to crystallize it to things that really matter. So I think that's one.
So recently, you written another book, right?
Something called the Devil's Dictionary.
The Devil's Dictionary. Yes,
how jargons are used in the investment business. Then, so a lot of guys online. I think Twitter has been a great learning platform to follow some of these guys, to take away the attention from things that don't matter to things that really matter. People like you, I think I wait for both of you when you blogs. I have a earmarked.
Our pleasure.
We honor it.
Yeah.
No, so I'll be sharing this podcast with my students at IIT Delhi, and most of them, the brightest of the people in the country. So most of them are probably future influencers and decision makers. Any message which you want to portray to these people, especially in the way that they can go ahead and make changes which are for the betterment of the country as well as individuals.
I think I have a lot of respect for those who are in IITs because I couldn't get through the exams. I don't think I'm qualified to give a message to them. But I would only say one thing, that people are very successful in creating money or getting good jobs and earning their money. But they mostly are failures in managing that money well and letting that money compound. Mm-hmm. So if India is a great compounding machine, whether debt at 8-9% or equity at 14-15%, respect the money that you earn and don't let it stay idle.
But that's a message from AMC MD.
No, it's a message from someone who has lost the first 10 years in compounding. Okay. And the reason I say this is a lot of youngsters today do not probably want to just work for till 60, 65, 70, but want to pursue a lot of other options. Sure. And financial freedom matters a lot. Sure. Starting on day one the right way can really make a huge impact.
That is correct.
You may not have to work for the last 20 years if you are able to get the first 20 years right. And there is no rocket science required for that. Just the basic concept of monthly savings and investing in the right vehicle can make a huge impact.
Yeah, I think you have tried to communicate the same message with your One Idiot.
So I have got, when we launched One Idiot 5 years back, I got a mail from a student in IIT Kharagpur saying that I have tried to do stock picking on my own for the last couple of months, but I have not succeeded. But this movie gives me, it doesn't teach stock investing, but it tells you what not to do. And it has been a huge learning for me. So, we feel good when
the student community person.
Yeah, and that has been the biggest segment. So by now we would have reached out to 12 lakh youngsters, colleges or in their first or second year of their employment, to just show the message of what is the discipline of investing. So I think the only thing I would say is respect money, and if the money grows, India will grow well.
Okay, great. So that's it from our side. Thanks a lot for giving us time.
Thanks for spending time.
Thank you, Mr. Parekh.
Okay. Thank you so much, sir.